Your financial advisor is becoming obsolete, and it's happening as you read this, not in the future, now. If you are still deciding what to do with your money by looking at reports every 3 months, following your feelings, and paying 1% to someone to manage it for you, you're directly up against a computer program that is always on, never gets scared, and has already looked at every company's financial discussion from the last 40 years. For the next 3 minutes, please listen to me as I'm going to show you something that will entirely alter how you view your finances. I mean investing with artificial intelligence. By 2026, it isn't a concept from a science fiction film. It's on your smartphone. It's affecting the markets, and the investors who get how it operates are slowly doing better, whilst everyone else is still awaiting information from CNBC. Today, I'm explaining the 3 most important changes taking place at this moment, and what clever individuals who invest for themselves are in fact doing in response. First, automated investment services, robo-advisors, are much improved. This isn't like the simple rebalancing of investments from Betterment from 5 years ago. These newer AI investment services use very big and sophisticated computer programs, large language models, to look at how people feel about current news, official documents from the Securities and Exchange Commission, the overall economy, and what companies say they have made, earnings, all at the same time. Services like Magnify, Composer, and even the AI tools from Schwab are offering average investors investment plans that used to mean you had to pay hedge fund rates. What gives you an advantage? How quickly it works and the fact that AI doesn't get emotional. AI won't sell everything in a fall in price. You likely did. I did too. Also, the very idea of what data is being altered by artificial intelligence. In the past, investors who follow the usual route would examine price to earnings ratios. AI, however, will look at things like how many cars are in the parking lots of stores from satellite pictures, what people are buying with credit cards, and what people are saying on social media, all in order to guess what a company will earn before that information is public. This other sort of information is called alternative data, and big investors have been using it for some time. But by 2026, services like Kahoot, Danelfin, and Trade Ideas will give ordinary investors the ability to do this kind of research for less than $50 a month. The advantage Wall Street once had because of having more information is disappearing, and doing so quickly. And this is something that surprises a lot of people. AI is becoming something you can invest in on its own. Beyond just buying shares in Nvidia, people are now considering ETFs that focus on AI infrastructure, funds that focus on the computing power AI needs, and even the rights to money from AI models, which have been turned into tokens. The companies with the essential components of AI, the data centers, the systems to keep the computers cool, the routes for the computer chips to be supplied, are the new, hugely valuable resources. If you haven't checked out funds like BOTZ, ROBO, or AIEQ for a while, you aren't hearing what institutional investors discuss all the time. By the way, before I explain the main mistake most of us make when investing in AI, could you please like this? It really does help many more people to see this, and what I'm going to say will be the part that most financial advice places completely avoid. Nobody likes to mention this, but AI doesn't get rid of danger. Instead, it brings all the danger to one place. Because all these programs learn from pretty much the same information and are set up to achieve similar results, they'll all begin to make the same investments simultaneously. This is how you get lightning-fast market collapses and the equivalent of a herd of animals all moving in the same direction, but at an incredibly rapid rate. the flash crash of 2010 showed us a little bit of what this can be like. So the answer is to not completely hand over your decision-making to AI. Think of AI as a partner, a co-pilot, rather than a system for automatic control. You need to grasp what your programs are doing and their reasoning. In 2026, the investor who has total, unquestioning faith in the algorithm will be the most vulnerable. The big changes to investing because of AI aren't in the future, they're happening now. The important thing is to get to grips with it and utilize it, or to disregard it and then be puzzled by continually falling profits. And if you would like a full explanation of the 5 best AI investing tools that I'm personally using at the moment, the video for that is here. Don't forget to subscribe for next week's in-depth exploration of AI and how it will shape real estate investment. I'll meet you then.